Welcome to subramani.com. Today I'm doing a small topic on important lessons on stock picking, and I'll also tell you that stock picking is a very small portion of financial planning. People who think they can pick up stocks, including brokers, are pathetic as far as financial planning is concerned. They just think they know to pick up stocks. Many times they don't. They end up having extremely long portfolios and not even across market cap, largely in B2, B3, almost the Z types. They trade a lot, doesn't mean they understand portfolio construction. They don't do allocation according to industry. They don't copy the index. They do reasonably well, but they never benchmark themselves and compare or things like that. So let me just tell you that today I'm just talking stock picking. It doesn't mean I may not even talk of asset allocation or portfolio construction. That would be separate. So first of all, stock picking. Stock picking for somebody like me is very easy. It just means I know two people to talk to before I pick a script. But it is not always that you will be able to do it, right? You need to have that Rolodex which tells you whom to speak with. I still get the numbers wrong, right? I still dial up wrong numbers and ask them wrong questions. So first of all, stock picking is hard work, real hard work, because you need to build a portfolio from, let's say, your age of 25 till your age of 60. I'm assuming 35 years. In 35 years, you need to pick up 35 stocks, right? So picking one stock a year shouldn't be very difficult, right? No, it is difficult because you do not know what to buy, how much to buy, you do not know the sizing. So you will have to buy slowly. For example, if you were to buy Bharti Airtel at 200 recently, you would have bought at 200, you do not know whether to buy more at 300, 400, 500, and then what is the target price? Well, I have seen Bharti pre-split at 1200, so will it reach 1200? Is that the new target? We don't know, right? So Bharti at least is identifiable. You can see that this is a sector which will survive, and Bharti is a company which will survive, so COVID or nothing doesn't matter. So step one, it is hard work. Accept that it is hard work. There are too many people now going around saying, we will create a great equity portfolio for you and there will be no pain. That's wrong, completely wrong. Equity picking is hard work. You need to look at, to buy one share, let us say you restrict yourself to the top 200 companies. To buy one share, you will have to go through at least 50, 60 companies before you decide on that one share. When you're buying that one share, you're trying to tell the world that I'm saying yes to this and I'm saying no to 199 others. This is like picking one dish in a hotel, right? You picked up a rava masala dosa means you said no to 149 other items. Exactly the same thing. Today at this point in time, I think the best share to buy is this and therefore I'm buying it. Could be any share which you pick up, but it means you're saying no to all the others. So this hard work is not visible to people, just like how Virat Kohli or Sachin Tendulkar's training is not visible. So a lot of hard work goes into picking up that one stock. And obviously for that you need to read the balance sheet. Reading the balance sheet again is very dull, very boring. A lot of people have videos on how to make it easy. It is not easy, it is boring, it cannot be made interesting. Even companies like Infosys, which is not a very complicated business, if you look at, say, Reliance or Larsen and Toubro, even the Infosys balance sheet is very boring to read. You need to know how he has created goodwill, what he has done, what he has bought, what he has sold. It's painful, seriously. Market can also give irrational returns for very long periods of time. Look at Bombay real estate, right? Absolutely no sense from a rental point of view. If you had bought a house in South Bombay and given it on rent, you're still not getting good rates. If you bought it in the suburbs of Mumbai, something almost nearer to Pune than to Mumbai, the rental yields are 1% and people are still buying and people are still selling. Absolutely no price movement in real estate. So real estate equities can give you irrational returns, very high, very low for very long periods of time. Look at Procter and Gamble, look at a Hindustan Unilever, these are definitely overpriced. That's what you think, but they continue to be overpriced for 15-20 years, like Mumbai real estate. You do not know when it will come down. Look at the dollar. Everybody tells you that the dollar is weak. I mean, in the US is printing notes, etc. But the dollar keeps getting stronger, right? So equity also can defy logic and rationale for very long periods of time. And there are advisors who used to promise 18%, 20% return just a few years ago. Now they have revised it to maybe 14, and they might revise it again to 9. So you don't know how the market is going to move. You do not know how the consensus return expectations are. So you do not know whether, when you get, suppose 1 year you get 28%, is it time to sell, or do you think 28 can be followed by 32? None of this is answerable, because after all the past data that you see, you will have one clause which saying the past is not an indicator of the future, right? So you have no clue. And companies which are simple, doing well, and you think everybody knows everything about that company, and that company defies logic and keeps going up, right? So it's very difficult to know which share to buy. But you have to understand, what I'm creating is the background for you. Equity pickers also have a problem that they take risk even when they don't have to. If they have reached a goal or very near a goal, after that they don't have to take a risk. But if you are a compulsive equity addict, you will still keep that money in equity, hoping for it to go up further. This does not make sense at all. For example, if you needed money, let's say you need money in 2040, and we are now in 2020, and you have invested somewhere in 2035, you realize that this corpus, even in a savings bank account or slightly better than savings bank account, will reach the amount that you need in 2040, and you're not revising that amount, right? You decided on that amount in 2020, and in 2035 you stick to that amount. You say, oh, okay, approximately this is what I need. It is high time that you remove money from equity. People don't understand when they have to remove money from equity. You don't try to remove money from equity only at the top. You have to remove it 3-4 years before your goal, maybe 20%, maybe 25%, depending on the situation of the market, right? And if the amount is already enough for you for 2040, you better remove it. So understanding risk is something very important. The need to take risk and the ability to take risk meet at a point, and that is the only point at which you have to take risk. When you don't need to take risk, just don't take risk. I don't know why this mad love for risk. Equity is a very attractive asset. Everybody wants to come into equity thinking they will multiply their money 3 times, 5 times, etc. Not always true. Also remember that the market is called the great humiliator. So exactly when you think you have understood the market, it comes and gives you a slap. All of us have had that experience, right? Right now everybody is telling you should be buying pharma, you should be buying infrastructure, you should be buying technology. Great, good to buy, but doesn't mean that the market will have the same time frame which you have in mind. You have 6 months in mind, market may have 6 years in mind. So an infrastructure fund which you buy now and you think is going to double in the next 5 years may actually do nothing for the next 1.5 years. You will sell out and then double in 2 years. Anything is possible. So when you buy, you need tremendous conviction and the ability to sit tight over long periods of time. And if there is a correction, you have to know whether the correction is temporary or permanent, which means even in investing, you need to have a stop loss, which could be a damn deep stop loss, but yes, you may need a stop loss. So market does not teach you any of these things in advance. You keep learning as you go. So you can buy on the way up, you can sell on the way down, you can sell on the way up, you can do anything that you want, right? So you bought a Kajaria ceramics at 36 and then you went on buying till it reached to 500. Possible? Yes, possible, right? And that price you may be selling, but your target was 500. Will you sell or will you look at the numbers and decide again? Again, a difficult question to answer, right? So stock picking itself is difficult. There are just too many videos trying to tell you that it is easy. It is not. It's just a feel-good factor to tell you, come here and I will teach you how to make money in the stock market. It is not so simple. You need to do some internship, work with somebody who is dealing day in, day out, find out how your emotions work during that time, create mock portfolios. There are enough places where you can create mock portfolios, compare it to some fund manager, compare it to another fund which you have created. So create one fund which you think is a growth fund and looking at growth shares, and create one which is value. Then compare the two, see what forced you to pick up, what forced you not to pick up, see which industries, look at companies which you hate, completely hate, which are currently out of favor. Everybody thinks that company is bad. Look at that company's balance sheet also to know whether you would have bought it if you didn't read so many people's opinion. Second, don't worry about what people say. People's opinion does not matter. You have to arrive at your decision based on your research, your numbers, your ratios, right? After you do that and you create a portfolio, compare that portfolio to some fund manager's portfolio. Look at a fund manager, look at his objectives and see what portfolio he has created, what you have created. Balance the industries, right? There should be very strong reason for you to be 25% overweight on some sector when the fund managers are not, or when the index is not, right? So do all that and keep learning. Just stock picking is not so simple. When we get into portfolio construction and all that, it will be much more difficult. But at least learn stock picking, learn which ratios to see, what is to be done. I am not running a tutorial here, but let me tell you that it is difficult. I may still do a tutorial kind of stuff, but I am not promising. But there are no shortcuts, and it is a long, painful process. Thank you.